If you're retiring soon, changing jobs, or sitting on an old 401k, the chances are someone's already tried to convince you where you should put that money. Before you move a retirement account, there are a few things you should know. What your rollover options actually are, how fixed annuities work, how fixed annuities compare to CDs, how the protection of your principal works, and when these types of products may or may not make sense for you depending upon your age and risk tolerance. Because just like Medicare, retirement is not a one-size-fits-all. While I primarily work with Medicare recipients, we also help those of you who are preparing for retirement. My name is Wendy. I'm an independent insurance broker located in Tulsa, Oklahoma. I primarily focus on Medicare planning. Many of the people I work with who are preparing for retirement also have questions about retirement income, old 401ks, and protecting their savings that they worked so hard to accumulate. For the retirement and income planning side, I partner with David Wilson with Wilson Investments to help our clients explore their options based on their timeline, goals, and their comfort level regarding risk. And today, I want to explain this in plain English. One of the most common questions I get is what happens to your 401k when you leave your job or retire? And one of the biggest misconceptions that accompanies that question is that you've got to do something immediately when you leave your job or you retire. That's not always true. Depending on the plan and your situation, your options may include the following. Number one, just leaving the money right where it is. Number two, you could roll it over into an IRA. Number three, you could roll it over into a new employer-sponsored plan. So if you're moving from one employer to another, you can roll over a 401k of the place you left into the 401k where you're going to work. Number four, depending on your age and situation, you could start taking distributions from that plan. And number five, you could reposition those funds or part of those funds into more conservative strategies designed around preservation and predictable growth. And this is where many people first start hearing about annuities. Some people love them, some people hate them, but the truth is that a lot of people just don't understand them. So what is a fixed annuity? A fixed annuity is an insurance product primarily focused on preservation and predictable growth. The easiest way I've found to explain a fixed annuity is its similarities to a CD at a bank. The first similarity to a CD is that your money in a fixed annuity is not subject to market risk. You also typically receive a declared interest rate. So if a CD says you're going to make 3.2%, a fixed annuity might guarantee a 3.2% as well, or maybe higher or lower. And the funds on either of those account types are intended to stay in place for a specific period of time. But there are also some very important differences. And before you jump to any conclusions in the comments or turn this video off, no, an annuity is never intended to outperform the stock market. Their role is generally stability, preservation, and predictable growth. That distinction matters. So let's dive a little bit deeper into comparing a CD to a fixed annuity. With a CD, you typically get those through a bank. You agree to leave the money in the CD for a particular amount of time, and you're guaranteed a certain interest rate for that period of time. CDs are commonly used when people prefer preservation, stability, and predictable growth over market volatility. Your money is also protected by the FDIC up to applicable coverage limits. There are also downsides to CDs that we also need to explore. CD rates can fluctuate significantly, and depending upon inflation and taxes, the actual growth is relatively moderate. Also, interest that you earn in a CD in any given calendar year is taxed, whether you take it out or not. With a fixed annuity, you're working with an insurance company. Your principal is designed to be protected against market downturns, and the growth within a fixed annuity account is tax deferred until the money is taken out. Many fixed annuities also offer guaranteed interest rate periods, preservation-focused accumulation, and optional income strategies later in retirement. Another important difference is how these kinds of accounts are protected. The guarantees in a fixed annuity are backed by the insurance company issuing the annuity. Insurance companies are also regulated at the state level, and states have guarantee associations that may provide certain protection up to state-specific limits if an insurer or the insurance company were to ever fail. But fixed annuities also come with trade-offs. Many have surrender periods. Many of them may limit penalty-free withdrawals, and they are generally designed for a longer period of time than a CD. A CD might have a 6-month, 9-month, 18-month option, where fixed annuities, generally speaking, would be 3, 5, 7, and 10 years, and maybe even longer. They are designed for long-term retirement planning, not a short-term investment. That's where suitability comes in. So you want to make sure if you choose a fixed annuity that you don't need to access those funds, at least in full, for a period of time. So who are some people that might consider a fixed annuity? Who might those be good for? This is where age, timeline, and risk tolerance really come into play. A fixed annuity may appeal to somebody who is approaching retirement, new in retirement, and is risk adverse and wants protection from market volatility. Fixed annuities also might be a good fit for people who value stability over aggressive growth, or just wants a portion of their retirement portfolio positioned more conservatively. For example, if somebody is going to retire in the next few years or has just retired and is planning on using the retirement funds to fund their life, in addition to Social Security, they may want some guarantees around their investment portfolio. Some people use the percentage rule. So whatever age you are at the time of retirement is the percentage of money that should be in guaranteed or safe money. A fixed annuity is guaranteed. It guarantees your principal and it guarantees your interest rate for a period of time. So if your risk tolerance is getting lower the older you get, a fixed annuity might be a great addition to your retirement portfolio. But if you're younger and still working and you have a longer timeline horizon, and you don't mind the risk of the volatility of the stock market, fixed annuity is probably not going to be a great fit for you. And again, there's no universal answer. And here are some important things people really need to understand. Not all annuities are the same. There are fixed annuities, variable annuities, fixed indexed annuities, single premium deferred annuities, and income annuities. And each one of those different types of annuities function very, very differently from the others. Some have fees, riders, liquidity restrictions, income guarantees, and some even have market-linked components. Others are much simpler. That's why retirement rollover options should not solely be based on a social media clip, a dinner seminar, or a person online saying annuities are either 100% amazing or 100% terrible. What really matters are your goals, your timeline, your tax situation, your income needs, and your personal comfort level with risk. And here's why I partner with David Wilson. The truth is that David handles our clientele base the exact same way I handle our clientele base on the Medicare planning side. There is no one size fits all. He absolutely takes his time and he believes in diversification. Neither of us charge any fees for our services. If you're retiring soon, in the middle of changing jobs, or maybe sitting on an old 401k and wondering what your options are, we'd be happy to help. You can contact me directly at the number on your screen, and we'll connect you with David. And if you find this video helpful, don't forget to subscribe and like, and we'll see you next time. Thanks for watching.